Hey everyone, and welcome back to another earnings video for today. So Amazon reported their quarterly figures a bit across the board for the quarter, revenue, EPS, and even AWS revenue expectations for the quarter. And so you might ask yourself, okay, but why is the stock down 7%? Well, if you were on the live streams with Jose and myself, first of all, thank you very much. Hopefully you join more live streams in the future. But second of all, you would know that the earnings call was extremely boring. Right? The analysts were asking a question and then the answer was 10 minutes long. I was like, okay, this is not going to end well. Plus, they also gave some non-answers, let's be honest. So let's touch on everything you need to know about the quarter, the headline numbers, and then a couple of things that were mentioned during the earnings call and the explanation behind the drop right now. Now, as you can see, first of all, year to date, the stock is now going to be down year to date. So has not performed well this year after this drop. Over the past 12 months, stock is still up 16.5%. And over the past 3 months, we're up around the same 14.5% or so. Amazon is one of the only companies of the Max 7 that is not paying a dividend and not buying any shares. Tesla is the other one. It's a company that generates quite a lot of free cash flow and just reinvests most of it in the business. It's not a company that thinks, oh, what will we do next quarter or 2 quarters from now? No, this is a company that thinks 5 and 10 years plus out. They're growing their total addressable market, right? Project Kuipers is the next big thing, let's say, but don't expect that to be material over the next couple of quarters. It's going to be material probably over the next couple of years and decades. So, for continuing, if you enjoy this type of videos, hit all the buttons, especially the notification bell so you don't miss any of the videos and the live stream. We really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Also, special thanks to Fiscal.ai for sponsoring this video. It's a stock research platform that you see here every single time on the channel and during the live stream. I'm going to show you a couple of things that are quite useful, especially during this earnings season. Oh, and if you use my link, you'll get 15% off. If you're a new user, you can try Fiscal Pro for free for 2 weeks. Now, the headline numbers were as follows. Let me put my face right there. So online stores, which is the largest chunk here, grew 11% year over year. Physical stores 7%, third-party seller services 11%, advertising growing 23%. I'll show you how big of a business that is already for them. Subscription services up 12%, and AWS is up 17%. So a bit of the same as last quarter. Now, if we go back here on Fiscal.ai, previously FinChat, we can look at the segments and KPIs for Amazon. So if we look at, for example, advertising. How big of a business is advertising for Amazon? And these are the quarterly figures. So actually a nice acceleration here in growth for the advertising segment. But if you look at the last 12 months, advertising is a $61.2 billion business for Amazon, growing 19%. $61 billion business, just advertising. Advertising is, of course, a high margin business. The high margin businesses for Amazon are growing faster than the low margin one, which are online stores and physical stores. If we look at subscription services, right? Subscription services, that's a $46.7 billion business for Amazon, growing around 10%. So even these business segments for Amazon could have been standalone companies that could be worth probably $100 billion or so. But then the big question is, okay, that's cool and all, but what about AWS? Well, AWS is a business that is generating $116.3 billion for them currently over the last 12 months, growing around 18% or so. The problem here with, AWS is that one, of course, since this is the largest one out of, AWS, Azure, and Google Cloud, it is the one that is growing slower. But they are dollar amount, they are the largest. They are much bigger than the other ones. And so there was this question that was asked in the earnings call, which you can look at the transcript right here. But let's just ask it the question. Why is AWS lagging behind Azure and Google Cloud? And we can see what the answer was. The answer was, in my opinion, a bit of a non-answer. So the response to the analyst was acknowledged that AWS year-over-year percentage growth may sometimes be lower due to its larger existing base. The CEO emphasized that focusing solely on growth rates is a moment in time view, and that customer experience and platform capabilities are more critical. I mean, okay. He also says that AWS currently has more demands than it can supply. That's the same with the other two players here. So this answer to me was not really a good answer, in my opinion. I mean, show some strength. Say, yes, plain and simple, look, we are just generating more in dollars. We are the biggest ones. I think they said that the second player is only 65% of the size of AWS, which again goes to show you that AWS is quite huge. They also told us that the backlog, because they're not giving us any projections for AWS growth, but they did say that backlog has increased by 25% year over year to $195 billion. So if you look at the backlog growing 25%, which is faster than AWS growth, then you might say that, okay, maybe those are good signs of things to come in the future. And this is basically the growth comparison here. We've got here the red line, which is Azure and other cloud services growing 39%, Google Cloud growing 32%, and we see that that has accelerated. For AWS, that's growing 17%, a small acceleration here quarter over quarter, but like I said, a bigger dollar amount. So yeah, there is maybe that question of, are they falling behind? If we look at margins for AWS, last quarter, amazing, right? 39.5%. This quarter, 32.9%. So you're asking yourself, whoa. What the heck has happened here? Well, the explanation was basically this. We did see AWS segment margins decline from a record high of 39.5% in Q1 to 32.9% in Q2. The largest quarter-over-quarter driver of the decrease, accounting for about half, is due to seasonal step-up in SBC expense, driven by the timing of our annual compensation cycle. AWS margins also saw headwinds from higher depreciation expense, as well as unfavorable impacts from year-over-year fluctuations in foreign exchange rates. So that's the explanation here, which means that I would assume that next quarter, we should, if we remove basically the SBC overhang, if you might call it that, we should see this go back up closer to 35, maybe 36%, and who knows, maybe going back closer to 39%. So that was the explanation on the margin hit here when it comes to AWS. Now that said, stock is down 7%, pretty boring earnings call. After the strength of Amazon, Meta, Google, I mean, you would think that Google would be up, but Google is not up. Microsoft is up a little bit more. But Amazon is, again, one of the best companies on the planet. Don't let this 7% drop here in price after it went up 45% over the last couple of months change your mind about the company. Look at what this company has done over the past 10 years. This is a company that knows how to expand its total addressable market. This is a company generating right now $664 billion in revenue and growing. It's probably going to be the first company that generates $1 trillion in revenue in 1 year. Of course, this is a company that is reinvesting the majority of its profits in the business. It has been like this for a long time. It's just so that right now, the business is just so good that we are seeing those tens of billions of dollars in free cash flow per year. But yes, there will come a time where suddenly this is just going to be an even bigger company that's even more profitable. And yes, I do expect them to finally buy back shares because, like I said, it's one of the only ones that doesn't do that. And I do think that the first step to return value to shareholders, because this is a stock, believe it or not, that has been underperforming the market over the last couple of years, share buybacks would be the first thing that they will have to do once, of course, they feel comfortable with all the investments that they've been making. Because despite the size of this business, despite the size of AWS, they still feel that yes, even at $120 or $130 billion forward growth for revenue generation for AWS, they still feel that this is early days. So I don't know when that will be, maybe 2030, we'll see. But yes, Amazon over the last couple of years has been underperforming, but this is a business that you buy and you forget. You just buy and you forget. There's a reason why I have this now at my number one. Could be soon number two because Meta has been going up so quickly. In my core portfolio, it's one of those companies where I'm not losing sleep on. Yes, the call was boring, but I mean, it's still an amazing business. So I'm not freaking out. Will I buy more? Like I said, it's still the number one, so I'm not in a rush to buy more Amazon at these prices. If we go back to 200, yeah, probably, but I don't know if we will. But you never know. You never know. Right now, it does seem like we are sitting just over that 50-day moving average at $218. Tomorrow is August 1st. We'll see what the market gives us. That's about it for me in this video. If you enjoy this type of videos, hit all the buttons. Hopefully this was helpful. We'll see each other maybe in tomorrow, Friday's live stream. And if not, I'll be releasing more videos throughout the next couple of days. So make sure you are subscribed with notification bells on. Would really appreciate that. Fiscal.ai is the link down in the description where you can get 15% off, or just try it out. You'll get Fiscal Pro for free if you are a new user. See you all in the next one. Bye-bye.